How is everybody doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to get everybody an update on the Basel III Endgame. This thing's been kind of kicked around. It's been going back and forth between regulators and bankers, and a lot of politicians kind of chiming in on what should be done, shouldn't be done. So, for a little background here, what happened was the Basel III accords basically that went through. So there were some proposed updates in the wake of the financial crisis that hit last year with the 4 or 5 banks that failed in the spring of 2023, and basically regulators came back and said, "Oh, hey, we need to raise a lot of the bigger banks need to hold more capital. Smaller community banks, i.e., banks being like 10 billion in assets and smaller, got real concerned about this and said, "Wait a minute, hang on, the smaller banks were not the culprits of this. These were much larger regional banks, 100, 200 billion type asset institutions. And, we shouldn't be, kind of lobbed in with whatever's going on with them." So fair enough. But they were concerned that, whatever regulations got put through would trickle down to them, as is usually the case. But I got 3 articles here that I wanted to bring in just to kind of update you, because there was a lot of stuff that came out. So the first one, so this was on Tuesday, September 10th. We had basically, Fed's bar to recommend revamp of Basel III Endgame, GSIB surge charge proposals. So what happened here? So banks could see a lighter version of the Basel III Endgame from their federal regulators based on recommendations that Vice Chair for Supervision Michael Barr plans to make to the Federal Reserve Board. Under Barr's planned reproposal, systemically important banks, the GSIBs, would have 9% higher common equity tier 1 capital requirements in aggregate. Other large banks would have 3 to 4% more as a result of including unrealized gains and losses on securities and regulatory capital, plus 0.5% more from the rest of the reproposal. The original proposal from July of 2023, which would have had a 19% increase for the largest firms and 6% for the next group, received strong pushback from banks and from other industries and members of Congress on both sides of the aisle. This proposal is part of the response to the 2008 global financial crisis. Not really, and is based on a framework from the International Basel Committee on Banking Supervision, with components partly responding to the 2023 bank failures. No, this is directly resulted to the 2023 bank failures. This doesn't really have anything to do with I would say this: it builds upon the framework that was introduced after the 2008 global financial crisis. But this is all in knee-jerk reaction to what happened last year in 2023. So reproposals of both the Endgame and the SIB surcharge will provide the public the opportunity to fully review a number of key, broad, and material changes to the original proposals and provide comment. Barr said in prepared remarks delivered September 10th. The new comment period will likely last for about 60 days, and implementation would likely take a year after the rule is finalized. He was commented saying, "I expect that given the importance of this proposal, we'll have an open board meeting on it. We should be able to schedule that soon," Barr said during a Q&A session after his speech. "We're definitely not rushing to finish before the election. We do our work over the long cycle. We're going to take the time to get it right." Barr anticipates support from his fellow Fed board members, as well as the FDIC and the Office of the Comptroller of the Currency, the OCC. "I believe that this set of reproposals will have broad support on my board, and they were developed jointly with the FDIC and the OCC. All 3 agencies worked hand in glove together to develop these proposals over many, many months. As for credit risk, the risk weighting would be lowered for residential real estate and retail consumer loans under Barr's recommendations, and the limited risk weight for low-risk corporate exposures would be extended to some regulated entities that banks consider investment grade and are not publicly traded. The operational risk and market risk components would also likely change. Operational risk charges would no longer be based on operational loss history, and fee-based activities would be measured based on net income instead of gross revenues, meaning a smaller base. In addition, Barr's recommendations include facilitating banks using internal models for market risk, whereas the current proposal would have constrained them. One criticism from members of the Federal Reserve Board was that the original proposal did not properly employ tiering, and Barr plans to recommend a number of changes to better reflect this principle, such as only applying the market risk and credit valuation adjustments framework to firms that engage in significant trading activities. Okay, so couple of things here before I go on to the next two articles. Number one, I had basically stated in previous episodes, like if you've ever watched like any of the banking updates I've done over the last 8 months, or the more recent the strategy room live streams, when this has come up, I have often said that being an election year, and given that this is such a big hot topic, I did not think anything was going to happen before the election. I basically had felt that about a month or two ago, that just with the way things were going, that they were going to kind of punt the football until after the election. And again, now they've come out with these changes. They're having there's going to be a comment period for 60 days, but they're basically saying that, yeah, even after the comment period ends, it'll take about a year to put this thing into an effect, and they're not willing to do anything before the election comes up. So, and again, like I said, this is such a contentious issue. Yes, there were people on both sides of the aisle that pushed back against the original proposal, but there were also some people that wanted it, i.e., Elizabeth Warren, what have you. And then I will say this here. So here's the thing you have to think about, and here's my big problem with this. They did this because they wanted to try to combat the two big issues that hit these banks last year, and that was namely unrealized losses in their bond portfolio and uninsured deposits. This will cover neither one of those things. They will try to basically say, oh, well, if you have more capital on hand, then that could happen. That could offset, losses you get in your bond portfolio, whatever. This could help you, uninsure. You get a bunch of customers with uninsured deposits or whatever. Look, you try to manage risk. You try to mitigate risk as much as you possibly can, but you cannot operate with zero risk. And there's some things that happen that are just out of your control. Like, the unrealized losses in the bank bond portfolios, that wasn't because of banks. That was because of what the Fed did. The Fed went on a tear, increasing interest rates. And, banks, unfortunately, made some bad decisions in how they invested in their bonds. They went long on their bonds. And that's what created the unrealized losses, thinking that the Fed would not increase rates, or they would not increase rates as aggressively as they did. So, so again, but again, that was mainly attributed to what the Fed did, not necessarily to what banks did. That was a repercussion of the Fed's actions. And just, again, holding more capital can help, but it's not going to ultimately, it's not like a 100% guarantee. It's not like it's going to totally protect you from these things or totally stop them from happening in the future. But here's what it will do, though. The more capital you require banks to hold, that means the less lending they're going to be able to do. And so you have to understand that trade-off there. Now, do I believe that banks are very well capitalized at the moment? Yes. Are banks way more, do the banks hold way more capital today than they did back in 06, 07, 08? Yes, they absolutely do. So I think the banking industry as a whole is more capitalized. They're in a much stronger position than they were years ago. But that being said, how much is too much? That's the big question there, because, again, hey, have banks hold 50% of their capital. Okay. But then they're not going to be making as many loans. You're not going to be getting loans out to consumers who need loans to do things like, buy a house and go to college and buy a car so they can get to work and things like that. So you just have to understand that there's pluses and minuses. There's trade-offs to everything. And the key is to try to find an equilibrium there. Okay. Second thing, or I should say, probably third thing here is, a lot of the regional banks have already been putting aside additional capital, kind of in anticipation of this. Like the original Basel III proposal got put out in July of last year. So they kind of knew something was coming down the pike. They, again, had the big pushback. And, obviously, I think all sides were looking for some kind of a compromise at that point. It looks like Barr has now come forward with that compromise. And like I said, they have been putting some additional capital aside. So whenever this thing does hit, they're probably going to already have the capital that they need, like, in place, so that they don't, it's not going to be probably won't be a big thing. So, okay. Now here's two more articles that came in on Friday, September 13th, from Friday the 13th. A long-awaited update on Basel III Endgame provides a bit of capital clarity. So the revamped set of capital rules in the Basel III Endgame reproposal should be more palatable for the banking industry. The changes came after the original proposal. Such a sweeping overhaul of a major regulatory proposal is rare, if not unprecedented, for the Fed in recent history, said Ian Katz, managing director of Capital Alpha Partners, LLC. He wrote in a note September 10th, but the intensity of the pushback from the industry and lawmakers was also unprecedented. Again, I think, like, just what I just said about it's about the capital issue. Like, it's not, two things. It's not going to stop what happened before, but what it will do is it's going to prevent you from making more loans than you otherwise could. So kind of two double whammy there. And that's why they got as much pushback as they did. If approved by the Fed board, the reproposal would need to go through at least a 60-day comment period and will not be completed before the U.S. election, but it has a chance of being finalized this year or early next year. No, it doesn't. We think there's only a small chance a reproposal would be finalized as a rule before Inauguration Day. There it is. While more steps are needed, executives from regional financial corps said the expected reproposal would give the company more capital flexibility. They and others also noted that Barr's speech provided some clarity. After more than a year of uncertainty regarding the complexion of final rules, we welcome any further steps forward that get us toward the finish line of actual rules of the road, Piper Sandler analyst wrote in a September 10th industry note. Plus, we would view a much lower capital hit as a win for the industry on this contentious issue. The most significant takeaways include, first, the reduced increase in capital, and second, keeping banks with $100 billion to $250 billion in assets out of the rule, except for having to include accumulated other comprehensive income, AOCI, and regulatory capital. That AOCI, that is the investments, banks' investments in their bond portfolios. JP Morgan analysts saw the planned AOCI change as positive, but noted missing details about the expected proposal. And then it talks into the GSIB surcharge, Fed's responsiveness implication for others. And then let's get to the last article here. So U.S., UK Basel III revisions pose implementation challenges for big banks. So the latest changes to the final Basel III framework proposed in the U.S. and UK are good news for global banks, but an uneven implementation of the capital standards across major jurisdictions could pose challenges. The UK Prudential Regulatory Authority, the PRA, said September 12th that it made substantial amendments to its original proposal after receiving 126 sector responses identifying 600 unique issues. The U.S. also announced a significant revamp of its original Basel III Endgame proposal on September 10th in response to strong opposition from banks, trade groups, and Congress. The changes could delay implementation, with the UK pushing back the start of the final Basel III rule adoption by 6 months to January 26th, while the U.S. timeline remains unclear. While UK banks will be relieved that the implementation start date has been moved, allowing them more time to apply the requirements, those operating internationally still face the challenge of juggling different timelines in different jurisdictions. The significant dilution of capital requirements for global systemically important banks and the latest proposal announcement could affect rule implementation in other major jurisdictions. So there we have it. So there's a little apprehension there on the part of the biggest banks in terms of, like, what does this mean as, say, like the UK versus the US and so on and so forth. So big happenings here. I think the big takeaway is that, we finally have a revised proposal. The revised proposal definitely seems a little bit more palatable to the industry at large. There's still a 60-day comment period. I would like to think that all of the issues that I brought up throughout this episode will be commented on in that comment period, but we'll see what happens. But I think the end result here is that There, if I was a betting person, which I'm not, if I was a betting person, I would be willing to say that there will be some more changes to this, probably slight, not probably not any further, like, major revisions, but I would propose that there would, depending on who gets elected here in November, will depend on some of the potential changes that we might see before this takes effect. But I don't think anything is going to happen before Inauguration Day. This thing is, I mean, I think they're what we read there, and if you read between the lines, that this thing is pushed back until probably sometime mid, next year at the earliest, I would say. So, but okay, but that's what I got there for that. Like I said, this was really a really important issue in banking. Just wanted to bring this out and get everybody an update on it. So if you like this episode, please make sure to like, share, and subscribe, as it always helps the channel. Please remember, we are on YouTube, Rumble, and all major podcast platforms. Please leave your comments down below. Make sure to check out some of the other episodes on the channel, and I will see everybody again real soon. Thanks a lot.